So now let us proceed further to understand how we are supposed to use this formula for calculation of answer of DFL, and how does it measure the percentage change relationship. And for that, say, I would like to take say the base of this information, because with the some values you'll be able to relate better. It has been given that say amount of the EBIT is 1 lakh, amount of interest is 60,000, EBIT minus interest, that will give us earning before taxes, that is an amount of 40,000, minus income tax at the rate of 40 percentage, that is 16,000, earning after taxes is 24,000. There are 10,000 number of equity shares and earning per share is 2 rupee 40 paise. So this is the basic information provided to us. The first question is calculate DFL. DFL stands for degree of financial leverage. The second question is if operating profit increases by 10 percentage, calculate a revised EPS and EBT, and so on. The questions are there. I request all of you to pay attention, do not write anything. As far as the answer of the first question is concerned, we can see that say we are required to find DFL, and preference dividend information is not given. So DFL will be found as EBIT upon EBT. As far as EBIT is concerned, it is an amount of 1 lakh and EBT is 40,000. So the answer is 2.50. That is the way the DFL is found. The second part of the question says that if operating profit increases by 10 percentage, calculate revised EPS and EBT. Okay. So just I'm giving explanation over here in short. From 1 lakh it will increase to 1 lakh 10,000. Amount of interest will remain same 60,000. Earning before taxes 50,000. Amount of taxes 20,000. Earning after taxes is 30,000. Number of equity shares 10,000. So EPS will be 3. And you can very well understand that this is 2.5. That is an increase in the operating profit by 10 percentage. So 10 into 2.5 is 25. And you can see it is 40,000 plus 25%, that is 50,000. This is 2.4 plus 25% is 3. That is the way we can make the calculation of the earning per share and EBT using the DFL calculation. Okay, these are the things that we understand. Now, basically we are going to have understanding initially before we calculate the answer or we write answer, the formula of DFL, that how the formula is like this. For that, so I am giving explanation in this way to you. Listen carefully. Change in earning before taxes is equal to change in earning before interest and taxes. See, over here, change in EBT is how much? 10,000. It is nothing else but it is the change in EBIT again by 10,000. So change in EBT is equal to change in EBIT. Now on both the sides, what I do, I divide with EBIT. So what will happen? So this will be percentage change in EBIT. This EBIT is kept as it is. This change in EBT is kept as it is. Now on both the sides we divide with EBT. So what will happen? Change in EBT upon EBT is percentage change in EBT divided by EBIT is equal to percentage change in EBIT upon EBT. So what I am doing, friends, on both the sides I divide with the EBT. So now you can very well understand. So this EBIT is transferred on the opposite side. So it is EBIT upon EBT, and this percentage change in EBIT is again transferred on the opposite side. So percentage change in EBT upon percentage change in EBIT. And dear students, we understand this is DFL, degree of financial leverage. What does that measure? That measures what is the percentage change in EBT for every 1% change in EBIT. So based on this discussion, we understand the formula of DFL, EBIT upon EBT, and it measures percentage change in EBT for every 1% change in EBIT. Continuing with the same information, you can see that said 2 rupee 40 paise plus 25%, it increases to rupees 3. Uh, Now friends, in order to understand how does DFL measures what is the percentage change in EPS for every 1% change in EBIT, we have to do something like this. See, earning per share is calculated as earning before interest and taxes minus interest. So it is EBT into 1 minus T is EAT minus preference dividend divided by number of equity shares. I give you a little more explanation. Earning after taxes is earning before taxes minus tax. So it is earning before tax minus earning before tax into tax rate. So earning before taxes is taken common into 1 minus tax rate. That is the way, so the earning after taxes is calculated. So this is what the way we have the EBIT minus interest is EBT into 1 minus T is EAT. I'm sorry, there is no preference dividend for the time being. So this is earning after taxes, and that itself is earning available to equity shareholders divided by number of equity shares. This is the formula for the EPS. Now, what would be the change in EPS? Change in EPS is equal to change in EBIT into 1 minus tax rate divided by number of shares. That's it. You can see, friends, over here there is a change in the EBIT by 10,000. There is no change in the interest. So in turn, there is a change in EBT by 10,000. You pay tax on that 4,000. So there is a change in the earning after taxes by 6,000 divided by 10,000. And we understand that so the EPS increases by 60 paise. So the same concept is applicable over here. We understand that say change in EBIT into 1 minus tax rate divided by number of shares is change in EPS. Now percentage change in earning per share is equal to change in earning per share divided by earning per share. What is the change in earning per share? It is equal to this amount. It is change in EBIT into 1 minus tax rate divided by number of years. I'm sorry, divided by the number of shares. That gives the change in EPS whole divided by earning per share. Earning per share is found using this formula. It is EBIT minus interest is EBT into 1 minus T is EAT divided by number of equity shares. This is the percentage change in EPS. So percentage change in EPS is equal to this number of equity shares and this number of equity shares will be cancelled against one another. So we have change in EBIT into 1 minus T divided by EBIT minus interest is EBT into 1 minus T. So this 1 minus T is cancelled over here and 1 minus T is cancelled over here. Percentage change in EPS divided by EBIT. Change in EBIT again upon EBIT into 1 upon EBT. Dear students, what I am doing on both the sides, I divide with the EBIT. This change in EBIT is kept as it is, and this EBT is also kept as it is. So now what will happen? This is percentage change in EBIT. So what I will be doing, percentage change in EPS divided by percentage change in EBIT is equal to this EBIT is transferred over here. So it is EBIT upon EBT. So this EBIT upon EBT is nothing else but it is degree of financial leverage. And this is indicating that what will be the percentage change in EPS for every 1% change in EBIT. Now let us write down answer for the question. Answer of question number 1. DFL is equal to EBIT upon EBT. EBIT value is 1 lakh. Divided by EBT value is 40,000. So answer is 2.5. Answer for the second question. If operating profit increases by 10%, calculate the revised EBT and EPS. So for second question answer, we have to prepare working note number 1. Calculation of percentage change in EBT and EPS. Degree of financial leverage is percentage change in EBT, EPS for every 1% change in EBIT. So percentage change in EBT, EPS is equal to DFL into percentage change in EBIT. What is degree of financial leverage? It is 2.50. And what is percentage change in EBIT? It is 10%. So it is 25%. Working note number 2. Calculation of revised earning per share, revised earning before taxes. So in that we'll make the calculation answer of, that is, we will make calculation of the answer like this. EPS and EBT. In case of EPS, we will have current plus change. In EBT, we will have current plus change. As far as the earning per share is concerned, currently it is 2 rupee 40 paise. Plus, that is an increase by 25%. That comes to rupees 3. And earning before taxes, it is 40,000 plus 25%. That comes to rupees 50,000. That is the way revised EPS and revised EBT will be found. This answer can be calculated using the table method also. So alternatively, you can have a working like this. Earning before interest and taxes 1 lakh plus 10%, 1,10,000. Amount of interest 60,000, it won't change. Difference of both of them is EBT 50,000. Income tax rate is 40%. So I'm writing directly earning after taxes, that is 30,000. Because 20,000 is the tax that you have to pay and the remaining is say 30,000. Divided by number of equity shares, it is 10,000. So earning per share is 3. That is 30,000 earning after taxes divided by number of equity shares are 10,000. Please write an answer. Try to do third part of the question on your own and put your answer in the chat box. So friends, over here we are required to calculate what is the revised EBT and EPS if operating income reduces by 20%. So answer for the third question. In that, write down working note number 1. Calculation of percentage change in EBT and EPS. In that we will have the working like this. Degree of financial leverage is measuring what is the percentage change in EBT, EPS for every 1% change in EBIT. So we can say that the percentage change in EBT, EPS is equal to degree of financial leverage into percentage change in EBIT. As far as the degree of financial leverage is concerned, it is 2.4, I'm sorry, 2.5 into negative 20 percentage. That comes to negative 50 percentage. Working note number 2, calculation of revised EPS, comma, revised EBT. In that, revised earning per share is current earning per share minus change, means minus reduction. Revised EBT is current minus change. As far as the earning per share is concerned, right now it is 2 rupee 40 paise minus 50 percentage of 2 rupee 40 paise. 2.4 minus 1.2. The answer is 1 rupee 20 paise. And in case, that is in case of EBT, it is 40,000 minus 50% of 40,000. So 40,000 minus 20,000. So that comes to 20,000. That is the way the revised EPS and EBT can be found. Fourth question is, okay, we can do this answer with the table method. So in that case, it is EBIT 1 lakh minus 20 percentage. That comes to 80,000. Amount of interest is 60,000. Earning before taxes is 20,000. Earning after taxes is 12,000. Number of equity shares 10,000. EPS is 1 rupee 20 paise. That is 12,000 rupees divided by 10,000 shares. So we can get both the answers, 20,000 and 1 rupee 20 paise. Fourth question is calculation of interest coverage ratio. Now, what do we understand with the term interest coverage ratio and what does that indicate? That is what now we are going to discuss. Everybody is requested to pay attention. Interest coverage ratio. First of all, I am taking some simple values to give you explanation and then we are writing this answer. Do not write anything, let me explain you. It is calculated as earning before interest and taxes divided by interest. What is EBIT? Let us say it is an amount of 5 lakhs. What is the interest amount? Interest amount is 1 lakh. So what is final answer? Final answer is 5 times. So basically what happens at say we understand that interest coverage ratio 5 times, it means that for making every 1 rupee of the interest, we have the income of rupees 5. Interest coverage ratio 5 times is indicating that for every 1 rupee of the interest to be paid, we have an arrangement of rupees 5. That is what this indicates. So if at all we have to pay interest of rupees 1 lakh, we have an arrangement of 5 lakhs. Interest coverage ratio is basically indicating what is the ability of the company to make payment of interest. Higher the interest coverage ratio is indicating the efficiency of the company, that is indicating the sound financial position of the company for making payment of the financial charges. Lower the coverage ratio is indicating that the company's financial position is poor and it would not be able to pay the financial charges properly if at all the coverage ratio is very marginal. This is the way the interest coverage ratio is calculated and this is what it indicates. Write down answer. ICR, in bracket write down interest coverage ratio is indicating what is the ability of the company to pay interest out of its operating income. Full stop. It shows that ability of the company to pay long term interest, long term debt interest. Full stop. Suppose ICR is 5, interest coverage ratio is 5. It means for every 1 rupee of interest to be paid, comma, EBIT is rupees 5. Higher the coverage ratio, shows sound financial position of the company and vice versa. Full stop. So now write an answer for this question. Interest coverage ratio is equal to EBIT upon interest as far as the EBIT is concerned. It is an amount of 1 lakh and interest is 60,000. So answer would be 1.67 times. Please write an answer. Fourth question. If the company does not want to reduce its EPS below 84 paise, calculate maximum affordable decrease in the EBIT slash operating income. So the question says that say what is the maximum affordable reduction in the EBIT if the company does not want its EPS to fall below 84 paise. Write down answer for the question in the chat box for this question. So we understand that over here it is EBIT less interest is EBT less tax is EAT divided by number of equity shares will give EPS. This is what's the routine sequence that we have. Now the question says that this time you do not want to have the EPS below 84 paise. So against EPS you will mention 84 paise. Number of equity shares are provided as 10,000. So based on this too, we can calculate the earning after taxes. It is 84 paise into 10,000. That comes to 8,400. Okay. The question is providing income tax rate is 40%. So earning before taxes will be 8,400 divided by 1 minus 0.40. That is 8,400 divided by 0.60. That comes to 14,000. We understand logically it is like this: earning before taxes and earning after taxes. So for every 1 rupee of the earning before taxes, you are required to pay tax of 40 paise. So earning after taxes will be 60 paise. You want to have earning after taxes of 8,400. So earning before taxes would be this amount. So it would be calculated as 8,400 into 1. Into 1 does not make a sense. Divided by 0.6. That comes to 14,000. This is a way we can make the calculation of the EBT 14,000. Amount of the interest is 60,000. 60,000 is say calculated after deducting 14,000 is calculated after deducting 60,000 from EBIT. So EBIT should be 74,000. That is 14,000 plus 60,000. So we understand that say in order to make sure that the EPS is not falling below 28 paise, your operating income should not be less than 74,000. Right now it is an amount of 1 lakh, so it should not reduce by more than 26,000. 26,000 is calculated as difference of 1 lakh and 74,000. So write an answer based on above working, comma, we can conclude that in order to make sure EPS is not falling below 28 paise, comma, EBIT should not reduce below rupees 74,000. Full stop. It should not fall by more than rupees 26,000. How 26,000 is calculated? 1 lakh minus 74,000. This is what we understand. I'm sorry friends, there is a mistake on my end. This is 84 paise. I request you to give answer for the fifth question in the chat box. if the company wants to double its EBT, calculate the revised EBIT at that time. Try to calculate answer on your own. So friends, we understand EBIT, less interest, difference of both of them is EBT. Right now the earning before taxes is 40,000. The company wants to double its EBT. So 40,000 into 2, that is 80,000. Amount of interest is 60,000. So the EBIT should be 1,40,000. That is 80,000 plus 60,000. So we can say something like this. In order to increase EBT to rupees 80,000, that is double, comma, the company should increase EBIT to 1,40,000, comma, it should increase by rupees 40,000. This is what this is what we understand. So a small revision of the entire question. In the first question, we are required to find the DFL, that is EBIT upon EBT, because no preference written information is given. In the next question, we are required to find that, say, if at all there is an increase in the EBIT, what is the revised EBT and EPS? That is what we have done. EBT and EPS, or we can go with the table format. Going with the percentage change format is required if at all the question is specifically providing that you are required to apply the concept of leverage. In the third question, there is a reduction in the EBIT by 20%, and with that, we are required to find what is the percentage change in EBT and EPS. That we have done again by both the methods. Fourth is a new question, that is the interest coverage ratio. So what is the operating income of the company, say, in comparison to the EBIT, that is in comparison to the interest. For every 1 rupee of the interest to be paid, what amount of the operating income that we have, that is what the interest coverage ratio is indicating. That is what, say, 1.67 times. Then we require the EPS of at least 84 paise. Then in that case, our EBIT should not fall, say, below 74,000. In order to make sure that, say, we have the EBT double 40,000 to 80,000, EBIT should increase by 40,000. That is the way we are required to write answer.